Today, we're talking about the life cycle of the infinite banking concepts. Stick around because we're going to tell you why it's important and how it applies to you.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today, guys, we're going to be talking to you guys about the life cycle of the infinite banking concept. And we're excited. We've touched on parts of this over the years, but today we're going to lay it out for you. And really what we've done is we've broken the life cycle of infinite banking into three different categories. First one is going to be capitalization. Second one is going to be utilization. And the third part of it is going to be when we're looking to wind this thing down. What do you think we get started?
Let's do it.
Awesome. Let's start with capitalization. So capitalization, I would say, is not technically the first step if we're splitting hairs here. And the reason I'd say that is there is some education that needs to take place just on the infinite banking concept first and foremost. But once you get comfortable on the idea and the strategy and you understand what you're doing, that's when the capitalization phase starts. And that's when we're actually going to start funding a policy. Remember, in this phase, Nelson's number one rule has always been never be afraid to capitalize. And really what he's referring to is don't be afraid to pay premiums. In this step, what we're doing is we're building up cash value inside of the policy. The reason that we're doing this is because clients, you guys have cash reserves and our cash has got to reside somewhere. And I could think I can speak for you, but we have yet to find a better place to keep cash reserves than a properly designed cash value rich insurance policy.
Karen, I was going to say, don't ever speak for me. Okay. But that time you hit the nail around the head.
Awesome.
Okay.
Awesome. So when we're looking to capitalize a policy, right, that capitalization phase is going to dictate some of the opportunities that we can act on and the timeline that we can act on them, right? So we've talked about policy design where we can kind of do a one and done and just hit the road and just start going. But some of the times, most of the times, is somebody's funding this on a monthly or annual basis and it takes some time to build up cash value. So in that phase, in this capitalization phase, right, we believe that education is the most important, or that's the hallmark of kind of this phase here is we understand IBC, we're capitalizing, we're creating cash value. Now what we need to do is we need to transition and start to identify some opportunities that may be available to us. And so if we're looking to start wholesaling, buy some single family rentals, maybe build a business, buy a franchise, and we haven't quite done that yet, that's when we start to look to maybe invest in some of those opportunities on the education side. Right. One thing I would add here is we do have some minimums, right? As far as capitalization goes, is we're trying to build as much cash value in the policy as quickly as we possibly can. So a lot of times we're looking on that top end. But I would also say that one of the minimums that we want to kind of keep in mind with clients is that when we go to deploy some of this capital is that you always want to keep 1 year's minimum inside of your cash value. So 1 year's kind of have to or base premium is what you want to keep inside that policy.
Awesome.
Yeah. Anthony, you want to take step number 2?
Yeah. What I would say, step 2, now we start getting some fun stuff. We start taking some action. Like step 1 is more getting the knowledge. I think the important piece of the capitalization is not just capitalize your policy, but capitalizing your mind with information. That just came to me. I know. Brilliant. Okay. So with the utilization now we have the policy, we have some cash value in there. We've got some education. What happens here sometimes is people get stuck, right? There are two things. Either one, maybe they don't understand IBC and they're like, wait a minute. If I use this money to buy this property or to do this, whatever, I have to pay interest. And they don't want to do that. That's where the education comes into play. And, in IBC, this concept, very different than what we were taught. So typically we're going to have to refresh that education. And that's why it's important to be working with a good IBC agent. He or she should never have a problem with going back to step 1 and kind of relearning or kind of refreshing what it is and why we are doing this. That's also a good opportunity to reread the book as well. Now, but also another thing where people lose in this phase is they get fear, or they don't want to use it. They don't want to take action. Right. Oh, they got the knowledge. Hey, I want to do the wholesale. I want to do that. But there's that fear of taking the first step. Right. And that's why it's important to have some mentors or people doing that journey with you, and whoever your IBC agent is, kind of help guide you to kind of push you, to execute that education. Now, once we're here, the first thing I would look at utilizing the policy or cash value would be, I would say, to get rid of bad debt.
What's bad debt, Anthony?
Right. I've had this conversation with people, and I mean, to me, what comes off to my mind is kind of debt that was not so supported by an asset. For example, you got a credit card. Maybe we have some student loans, or really the way that I would summarize bad debt is a debt that causes you stress every time you make that payment. Right. So maybe that is a mortgage or something with an asset. If it's causing you stress, then let's address the stress by either getting rid of that debt, or maybe kind of reformulating our thought process to start thinking more abundantly, or to start buying some assets. Because let's say we got rid of that bad debt. Now there's a couple ways that we can use it, and really, like Robert Kiyosaki says, you spend your money on one of two things. You either buy an asset or you buy a liability. And we define that as an asset brings money to you, liability takes money from you. Infinite banking works for both. And there's a lot of people that will use it for liabilities, meaning maybe to finance their car, pay for vacations, home improvements, and really anything that is not producing cash flow. Now, it works for that. But what I think, though, is that there's a common misconception out there that by taking loans from your policy or having your money moving, just having your money moving is going to create wealth, or using a policy loan to finance a car is going to build wealth.
Anthony, where do you think that misconception stems from?
It's coming from other agents trying to do IBC. Well, I say trying because I don't think they're doing it well. They're misleading clients. I mean, there's a guy who's got a good following on social media, and he talked about, hey, I just bought this Lamborghini, and then I just, instead of paying to get a loan from a bank, got a loan for my policy and paid it back. And then when I got done paying it off, my policy grew by $70,000 more than the premiums I put in. Okay. There isn't anything that is untrue, right? But they're not related. The policy didn't grow by 70 grand because he borrowed it and put it back. It grew by 70 grand because that's what the policy is going to do. It's going to continue to grow. So the key thing is, when we take a loan, it's not from your policy, it's from the insurance company. We're just using your policy as collateral. So by taking a loan and paying it back, literally has nothing. Loans have zero to do with your policy. They're really two separate transactions.
Great point, Anthony. I'm going to jump in there, is because we've had people that have called us up and said, hey, can you take a look at my policy? Right? Is I'm looking at the math here and it's not quite working out. And what they were told was that having a loan on the policy is, quote unquote, the magic that makes this thing work. That couldn't be the farthest thing from the truth. Taking a loan against your cash value is not the magic that happens. It's what you do with it afterwards. And so, again, the misconception out there is being perpetuated by a lot of people that don't have a proper understanding of how infinite banking can and should work. So,
and what we want to have some realistic expectations.
Yeah.
Right. IBC isn't some magic pill and just taking a loan and all your worries are going to go away. Right. It is a great tool, but you got to take some action. And I just think people are overselling it. So then people either eventually they figure out, hey, this is not what I was told, and they get upset and they start bad mouthing whole life and IBC. That goes back to the insurance companies. The insurance companies like Mass Mutual said, I don't want to do IBC anymore. I mean, it's all for stuff like this.
Yeah.
Because what he's that policy he was let's just go an example here. And let's say at a certain point in time, let's just say year 10, right? Cash value is projected, if you pay your premiums, to be $100,000. Now, if you take a loan, whether it's for a liability or an asset, cash value is still going to be $100,000 because we never touched your $100,000. We use the insurance company's money. So buying a liability and paying it back, or his Lambo, he's still going to have $100,000, but now he has a Lambo, or he has a depreciating value of that asset, right? So he really didn't come out much ahead. But instead, if we would have used that loan to buy an asset or a cash flowing asset and paid it back, in this example, we're still going to have $100,000 because we never touch your policy. But now we also have a cash flowing asset in addition to that $100,000. So using the policy, you can use it for liabilities or assets, right? But if you want to grow your wealth, you can't build wealth by buying Lamborghinis. Okay. Maybe that's the summary. And sorry to getting a little fired up here, but I've been seeing this stuff and it's getting frustrating.
It's getting worse. Yeah.
But now I will say there's times when you should use your policy for liabilities, and there are some advantages to it. And some of the advantages are it's not reported on your credit. There's no approval process. There's a flexible repayment schedule, right? So there's a lot of advantages. So, but that's where you kind of need to figure out what it is you're trying to do and what is the best way to finance that purchase.
Yeah. All right. Now we're moving on to kind of the third phase of the life cycle of infinite banking. The first step that we talked about was the capitalization phase. The second one was the utilization phase. And this third step that we're going to be referring to is really the winding down phase.
Okay.
Right. We're referring to this as winding down because we are not big fans of the idea of quote unquote retirement. The idea of just kind of sitting around and doing nothing does not hit home with us. I'm a bigger fan of anticipating that I'm just going to do what I'm doing, right? Producing to a certain extent, just at a much smaller level. And so that's why we're referring to this as winding down. When we get to this phase, one of the hallmarks is how are we going to pay premiums, right? Up until this point, we've been paying premiums out of pocket. And so now we're looking at other options to either pay premiums from other avenues and or shut premiums off altogether. One of the easiest things to do when we're in this phase of winding down is to shut off premiums. Is you just elect to reduce paid up. That means we just call up the insurance company. We say, hey, listen, we're not going to pay premiums anymore. We'd like this election, and our premiums will reset to zero, and they have no expectation of premiums being paid. Some of the other options that you would want to consider would be using the cash value from the policy to pay premiums and or maybe some of the dividends. And even additionally, right, as we start to downsize at this point in our life, maybe we sell a personal residence, maybe we're accelerating the spend down on some retirement vehicles, and we do have some extra capital somewhere that we need to put in a safe, conservative place in that phase of life. And so maybe we use those types of assets to pay for premiums at this point.
Well, all right. So Cameron, thanks for sharing. I think the point here is there's a lot of options on these premiums. A lot of times when the way we design it, we don't know when you're going to wind down or really if you're going to wind down. So we could design the policy to have that flexibility for the continued deposits. Right. And now that my kids have kind of moved on, right, I'm seeing some mini windfalls, right, of not having to pay their car insurance and provide them food. But, also some of our expenses are going to go down, particularly, let's say you're spending a lot of money on hair care, right? Could be maybe you're not going to have as much or any hair. Maybe your hair's winding down. And imagine all the money sending to Paul Mitchell can now be reallocated to pay the premiums. But I'm just saying, let's just keep our mind open, right? There's going to be some many windfalls, right? Now, let's talk about when we're done with those and we've stopped putting premiums in, want to start taking some cash out. Typically, there's going to be two ways to do that, either a withdrawal or a loan. Now, a withdrawal, that's where we're actually taking money out of the policy, which means there's no loans, there's no interest accruing. So that is an advantage. The downside is it's permanent. We can't ever put that money back in, but we're also breaking the compound interest curve when we start withdrawing. However, if we were to do the math, right, the most efficient way or how we can maximize taking cash flow out of the policy, the first step is to do withdrawals. And we can take withdrawals out up to your basis. And your basis really means kind of whatever you put in, you can take out without paying taxes. So the most efficient way is we do withdrawals up until the basis. And then at that point, we shift from withdrawals to loans. Now, with loans, we're taking a loan so that interest is going to accrue. Okay. But we have zero interest of repaying that back. Those loans and that interest will be paid back with the death benefit. And how we're calculating how much to take out, we're anticipating that interest accruing. So you don't have to worry about paying that back, or what if you don't? Okay, we don't have to worry about it. Another advantage of loans is loans are temporary. They can be repaid back. So sometimes we're winding down, and then maybe we might have another phase where maybe we sold another property, or maybe there's a windfall. I mean, we're big on having policies on both spouses. So if you're married, odds are somebody's going to go first, right? And then that surviving spouse is going to have that death benefit. They're going to want to put it somewhere where it's safe and liquid. And if we have policy loans, we can place it right there to be more efficient. And now it's safe and liquid. But also, when we're winding down this phase, the death benefit and our legacy start becoming more important, right? And so that's just going to even increase the legacy that we are going to have. One piece of winding down I want to point out is that part of that process needs to be educating the next generation, because I tell you, all of our clients is going to have a much larger death benefit than they ever imagined. And we need to make sure the next generation, or whoever's going to receive that money, learns these concepts. So when they need to learn now, when they have a little, so when they get a lot, they're going to be able to manage it.
Great point. That winding down phase is hopefully, right, we've got all that kind of implemented and in place. And that winding down, or the education process, needs to start much, much sooner than what it has typically. And so hopefully we kind of reach out, get that next generation educated as quickly as possible. But guys, we really hope this gave you kind of an overview on the life cycle of infinite banking, broken down into three categories: the capitalization, the utilization, and then also the winding down phase. Hope you guys enjoyed this episode.
Go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.